Hi everyone, welcome to Foxon Media Digital. My name's Amy and today I'm joined by Catalina Secreteanu, Morningstar's Global Head of Client Relations, and Robert Edwards, who's Director of Product Management for Morningstar ESG Indexes. So welcome both, great to have you on the channel.
Thanks,
Thank
Amy.
you.
Yeah, of course, it's great to have you. You're one of our partners for the Summit for Asset Management ESG, and we wanted to catch up with you both to get a little spotlight on yourselves and your company. So could you start by giving us a brief overview of yourselves?
Sure, happy to. I have been with Morningstar Sustainalytics for a little over 11 years now, and I'm based in London, although I have spent some time with the company in Sydney as well. In my current role, I primarily focus on the commercial product strategy across a range suite of ESG products designed for investors, not just in the UK, but as well as internationally.
Yeah, and thanks, Amy. Yeah, so again, Rob Edwards. My title is Director of Product Management for Morningstar's ESG Indexes. I'm based in Morningstar's London office. I've been with the firm nearly 10 years, and my day job is really trying to figure out what new ESG index products we want to launch. So, and then also the ongoing maintenance of any of our ESG indexes globally. So again, thanks for having me.
That's great. Well, thank you both. And in light of your focus areas, then let's start with thinking about what the current ESG and climate market trends and developments look like right now. It'd be great to have your perspectives on this.
I would say that it's been a tremendous year for regulation on ESG and climate, both in the UK as well as internationally, with really many of the deadlines pertaining to climate disclosures under TCFD, as well as some of the reporting requirements under the EU Action Plan coming to fore this year. If we do continue down the path of highlighting climate as one of the key trends for this year, research from Morningstar actually shows that approximately two-thirds of the global sustainable funds launched by the end of the third quarter this year have had a focus on climate, particularly on climate transition. So this is, I think, what a strong point to demonstrate that climate is really on all of our investor clients' mind, both driven by regulatory requirements, but also by kind of market drivers around product creation. And certainly in this context, stewardship has continued to be one of the key tools used to assess alignment with net zero commitments, with many of our investor clients looking at engaging with the highest polluters in their portfolio to understand their path for transition.
Yeah, and what I would add is that even though it may not feel like it at times, we are making progress. I'm hopeful for the industry because it's clear that investors are getting more and more sophisticated in their approach and their understanding of sustainable investing. We believe next year you will continue to see evolution in indexing and passive investing into areas that historically have not received as much attention. For example, post a release of TNFD, biodiversity and land use will come to the forefront. You also see more of a push from the industry as well as regulators to align investments as well as indexes to the EU taxonomy framework. I also think COP28 will continue to drive more resources and focus into green technologies, as well as put a spotlight into water risk. And these are all could potentially be focus areas by not just index providers, but also asset managers or asset owners. And lastly, I'll just say that I see Paris line benchmarks continuing to gain traction in Europe. The fact that regulators have clarified that Paris line and climate transition benchmarks are in fact eligible for Article 9 classification in SFDR should be a net positive for the climate transition type of products. Outside Paris line and climate transition benchmarks, most other Article 9 products have been typically concentrated equity or corporate debt portfolios. And this is because there's very few securities to select from, notably those in green industries or companies that are already far along in the climate transition. So, what we like about Paris Line benchmarks is they're not just a satellite holding in a portfolio, they're actually suitable as a replacement for a core holding in an investor's portfolio.
Thanks, Rob. So, in light of all of this, then, all of those trends and challenges that both of you just mentioned, what is Sustainalytics and Morningstar's indexes doing to help companies' investors identify the risks associated with climate change?
Thank you for that question, Amy. Firstly, I would say that we are supporting our clients to meet the mandatory regulatory requirements under TCFD in jurisdictions like the UK and Switzerland. And certainly, I think we do acknowledge that the level of transparency and granularity required for some of these climate disclosures are really unprecedented. And secondly, with our current range of climate solutions, we're really also looking at being able to support our clients with a range of tools pertaining to risk management. And perhaps I would say that we're looking at being able to support our clients in two key areas. The first one is in enabling them to assess the full impact of a company's value chain across greenhouse gas emissions, scope 1, scope 2, and scope 3. Noting, of course, that scope 3 can constitute 60% of a company's overall greenhouse gas emission footprint. And secondly, we are also enabling our clients to analyze how comprehensively is a company's commitment to reduce its emissions gap. How prepared is a company to transition towards a low carbon economy? And we look at a really wide range of management performance metrics related specifically to climate, from is the management team's remuneration linked to emissions reduction target? Does a company use an internal carbon price for decision making? Or how is a company engaging with its suppliers to understand how well suppliers are looking at both tracking as well as reducing its own their own carbon emissions? And again, kind of summarizing our responses is both enabling our clients to meet increasing regulatory requirements, as well as supporting their assessment from a risk perspective of the companies that they own, which have a significant a significant tilt towards climate risk exposures.
Yeah, and I think I'd like to start to answer the question by actually introducing a recent survey that we did, and we call this the 2023 Voice of the Asset Owner Survey. So I'll speak about our quantitative part of the survey. So this is a survey we did with 500 different institutional asset owners across the globe. So 200 of those were in Europe, 200 in North America, and 100 were in Asia Pacific. And this is actually the second year we've conducted the survey. And one of the key findings of that survey was climate was clearly king. Net zero was the overwhelming number one answer when it comes to the factors that asset owners found most financially material to their investment process. So I think this is a clear signal that asset owners are still very much focused on aligning investments to a 1.5-degree trajectory. And based on our survey, asset owners do really find E, S, and G factors material to their investment process. So to be clear, we're not talking about values alignment or some sort of ideology. We're talking about asset owners finding this as part of their fiduciary duty and material to their investment process. And I think this really showed up, this year and was clearly demonstrated by things like extreme weather events and seemingly endless summers that we had, across the world. So keeping those results in mind, we really want to align with these principles and these key thoughts with asset owners who are really helping drive this climate transition. And what we believe is that indexes reflect the markets as a whole, with all of their constant churn, change, evolution. Indexes do evolve as the markets evolve. So kind of bridging some of the things that Catalina brought up, our indexes are starting to incorporate some of these key forward-looking climate data points to evaluate not just if companies are setting targets, but are they making real progress towards those targets, and are they decarbonizing in the real world? We're also working, closely with folks at Sustainalytics on how to incorporate very financially relevant metrics like physical risk into our different climate indexes.
No, that's great. Really good insight from both of you. And it's certainly challenges that we're seeing from the asset managers and the asset owners themselves when it comes to like lack of historical data. So like you say, having those forward-looking metrics are really critical. So that's fantastic. And then in terms of some of the benefits of working with Morningstar Sustainalytics and the Morningstar Indexes team on the topic of ESG and climate change, could you elaborate on that a little bit?
Yeah, sure, Amy. I can take that one first. So I think a key benefit of working with Morningstar Indexes and Morningstar Sustainalytics is really we can help firms tell their ESG story. Morningstar is unique in that we don't just have security or company level data. We also have portfolio level data as well as really robust reporting solutions. So having this data not only lets the fund and wealth management industry implement their ESG strategies or passively track one of our Morningstar indexes, they can also report back on the impact of their ESG decisions as well as fulfill some of the key reporting requirements, both at a corporate and a fund level. So from an index perspective, these data sets really allow us to also offer a wide variety of custom index options. As we know, across Europe and across the globe, there's differing ESG preferences that clients want implemented. So having this rich database of ESG portfolios also allows for a very comprehensive comparison between peers. And this also allows to track what ESG themes are trending in the industry and doing things like conducting a gap analysis. For example, we've conducted some of those analyses ourselves, and we find that there's still a shortage of socially focused fund products, for example. With important topics like the just transition gaining steam, we plan to continue to build indexes that help facilitate investments and bring awareness to important social topics such as gender diversity, LGBTQ rights, or UN SDG alignment, just to name a few.
And perhaps building from what Rob has just said, we've also, I think, kind of already demonstrated our ability to distill down complex research and data into easy to understand signals, like in the case of globes used in the Morningstar sustainability rating for funds. And also building off Rob's point related to support and enabling our clients tell their ESG and climate story. We have spent significant time this year in collecting feedback from our clients to ensure that we can translate our climate ratings into easy to understand signals. So to this point, not just supporting our clients with a comprehensive and transparent methodology that can be used to inform investment decision making, but also engaging with our clients directly as well as to their end clients to understand or also to ensure that the key climate data points that we're putting out in the market are easy to understand, and we can translate what is a relatively complex science and approach into clear and transparent signals, and of course ensuring that this research can also filter into the work that the index team is doing pertaining to custom indices and benchmarks. So certainly, I would say enabling our clients to strengthen their ESG story and to have the same compelling narrative when it comes to aligning what they do internally on climate to how they communicate that externally is one of the key benefits of working with us, and certainly an area that we've been spending significant time this year in getting right.
Yeah, those are excellent points. I know that we often talk about accessibility to data and how accurate the data is, but actually you're very right that once those data points are there, taking those and actioning them, engaging with your clients, that's all part of implementing it and using it successfully, in an ESG strategy. So it sounds like you've got a really great model there. Of course, people were able to meet some of the team at ESG London last week, and we hope that you'll be back on our channel and back at our events to kind of tell us more and update us on where things are. So thanks so much for joining us both. I know it's been short and sweet, but fantastic insight into what you're doing at Morningstar.
Thank you, Amy. Look forward to that.
Thanks, Amy.
And thanks everyone for joining. Don't forget to follow our YouTube channel for more content on challenges and opportunities in asset management, wealth management, and ESG. And don't forget to give this interview a thumbs up and hit the subscribe button.